Good evening, everyone. Time for another silver update. This is the 1 hour chart provided by netdna.com. You can click on the link below. This is a trend line I've been watching very, very closely because I'm thinking that there may be a kind of sell-off like we had in September. I'll show you when we get back to the other chart why I think that's the case, but silver seems to be kind of churning at this point. I was expecting to see more strength. Now, if you see the MACD, it does seem to be rounding up, so it is quite possible that this trend line will hold, but as you can see, the trend line is at least weakening and kind of establishing a new lower level here. So this is the type of pattern that we saw back in the September SmackDown. If you remember when Clive Mon came out and gave his call, which was very, very well-timed call, I actually was so impressed by it that I did pick up some AGQ puts based on that call. But if we go out to the 8 hour, if you remember that, probably want to go to the 4 hour. Hopefully it's still within that range. Give us a better line to draw. And no, we have to go with the 8 hour because we just don't have enough data. So if you remember that call, he was looking at this trend line right here, and we'll go with maybe 3 or 4 touch points roughly around there. That was the trend line, and what we saw was this kind of weakening of the price, and you know that what we got eventually we just got this waterfall cascade. Now, a lot of people criticize me about using these charts, and their criticism, of course, is always the same. It's, why are you looking at these charts? Because you know the price is completely manipulated. Well, that's true and it's not true. First of all, the volume is informative. You can tell that the volume does correspond to the price action. The technicals are still valid in these prices. You have to remember, even though I believe the figure that FOFOA quoted was only 5% of the physical silver in the world is actually delivered on the COMEX, but I think the saying goes that supply and demand determine price, but it's at the edges. In other words, it's not the vast bulk of the commodity you're buying and selling, but it's just that right at that edge where they meet that it's established. So 5% could establish price, but I think that's, with the volume they're doing, that's a little bit slim. But nevertheless, these prices are important because the technicals still remain valid because of the way the price behaves, and primarily the reason why these charts are important is because sites like APMEX and Gainesville, and probably others, I'm not sure about Provident and the others, I haven't researched it thoroughly. I'm pretty sure that Tulving is as well. They are linking to these prices. So these prices do connect to the real world because they gauge physical silver. I was up watching this night, and when it got below 30, I was starting to get an itchy trigger finger there, and then when I saw it touch 28, I couldn't help but pull the trigger. It actually went down to 26, but the name of the game is going to be buying the dips. You're never going to get the exact bottom, but I found through experience, if you've been watching a particular issue and you start to see it sell out really quickly and you start to see the website starting to crash, these are the ones that link to the price, it's a pretty good bet that you're catching a bottom or very close to one. And that's obviously the name of the game, is stacking physical silver at a decent price. You want to buy the dips. The reason why you want to buy the dips is because you become much more likely to be one of the strong hand holders. So if you bought over here around 25 bucks or so, it's highly unlikely, or it's not highly unlikely, but it's less likely that you were shaken out when we went down to here. You were still up 50% or so and you stayed in for this. Now you can see we actually came all the way back down to your buy point, and of course that would have been an opportunity, if you're a serious stacker, to stack more at that price. So we're looking for dips, not because we're bearish, but we're looking for dips to add to our positions, because hopefully we believe that this is a long-term bull market and it's just getting started. So I wanted to segue over to some of the government information, some of the things that are going on. The first thing I wanted to look at is and these are going to be the reasons why the fundamental picture has not changed in any sense at all. And the fundamental picture is going to be supply and demand, of course. We know that the demand of silver is rising rapidly. This 6 million print we had on the Silver Eagle in the month of January was really big. Of course, I think that, as others have pointed out, that probably the mint was rolling over the numbers to next year. So January always seems to be a huge year, but the purchase of Silver Eagles continues to go up a lot. That's the demand. The supply, as Chris Duane has pointed out in his excellent SBSS series, I advise you to watch all those. He really goes into the fundamentals, and the fundamentals are that the supply of silver really isn't growing. That's not surprising considering the fact that it's a suppressed price. So the law of supply and demand would tell you that it's not in anyone's interest to mine or sell silver when the price is suppressed. But so that's the supply and demand of silver, but you also have the supply and demand of money. So money also has its influence on the price of silver, and you can see that the debt is just continuing to skyrocket. If you remember back in the summer, we were debating the 15 trillion. We're well above that. If you remember my video, I pointed out when the GDP was crossed, which we're at 15 trillion 014, we're not 15,330. So we have rapidly, by the pace of by the pace of $315 billion, we've now surpassed the GDP with this debt. So it's rising very, very rapidly, and it shows no signs of decreasing. So the fundamentals about money couldn't be more bullish for silver. And of course, the fundamentals about silver couldn't be more bullish. So it's a completely bullish situation, and nothing has changed. We're just looking for dips to buy probably the greatest opportunity of a lifetime, or actually probably many lifetimes, that anyone will ever see. Now I want to take you over to another government number. I covered this on the blog. This is actually from Simon Black, and the title of this is U.S. Department of Labor now reduced to Soviet propaganda ministry. And it really is. It's gotten to the point, really honestly, that it's laughable. The statistics, and there's another article about the Fed is engineering the re-election of Obama, and but it's gotten beyond absurd here. You can see this chart tells you the story, and this is absolutely key, because it doesn't really matter what they say about what the unemployment rate is, or all these cooked numbers. If you just look at the participation rate, then that's going to tell you all you need to know. The reason why this is such a key number, and you can see the blue line is the number not in the labor force. That's this left grid, or left section here. This right section is going to be the percentage participation rate. So what you're seeing is that the amount, I'm sorry, I had it backwards, but the number of people who are not in the labor force is continually rising. It's rising steadily. There's been really no change. If you look, you're looking at May of 08 to January, and you can see the number of people not in the labor force has steadily risen, and the number of people participating, the percentage, has steadily fallen. Now, what does that mean? That means that these people are not paying taxes. That means that the governments are not collecting the revenues they need to support the budgets that they're running. Now, if we go back to the national debt clock, you can see this number, and we're going to connect here when we get to the housing situation. We're going to connect the federal spending to the state spending. But you can see on this federal spending number, it is rising. And the first thing you want to see with these figures, if they're actually dealing with a situation, this number should be falling, not rising. The amount of money spent by the federal government should be decreasing at a much more rapid pace than it's even increasing right now. That would be an indication that they've actually tried to face the music and they're cutting what they're spending. Now, if you remember when Bernanke was in front of Congress the other day, he warned against cutting spending because it might increase the odds of this recovery being harmed. And the question one would have to ask with that is, what recovery? There is no recovery. So Bernanke is a abject failure. If you remember, his dual mandates are steady employment and low inflation. Well, they're lying about employment and they're lying about inflation. So Bernanke is a double failure in his duty as a Fed chief, and he's failed in both mandates. Now, I want to take you over to the mortgage situation because this is just another example of how these people have not learned their lesson. This is just kicking the can down the road. This is the mortgage deal. Now, the mortgage deal that they're talking about is about the robo-signing fraud. And just to summarize briefly, what happened was that these mortgages were sliced and diced into these various derivative products, and in the process of that happening, the original signatures and the original contracts were lost, probably because no one bothered to pay to do the paperwork to have those. So there were some homeowners that were foreclosed upon, and they demanded the document, and they couldn't produce it, and the banks got together and they produced this MERS database, which is, in my opinion, kind of an ex post contract thing. And if I were a judge, I would nullify that thing and tell the bank, until you can produce the document, they have the house, or something like that. And that was starting to happen in some of the states. So obviously they got in a panic and they figured, well, we have to put this thing to bed real quick. So they're working on this deal. Now, this deal that they're working on is basically going to be a penalty that these banks will pay. They're talking about a settlement of roughly $25 billion. And they are saying that the benefit to homeowners could actually be $40 billion or so. Now, what the actual meat of this settlement is, it's right here. It would also include $3 billion in refinancing for homeowners who are current on their payments but unable to refinance because they owe more than their homes are worth. Okay, so they're talking about changing their loan structure so they can continue paying, and I don't know what kind of interest rate they're thinking about, maybe 3, 4, 3, 2, 1. Why don't they just give it 0? I don't know. The other strange one here is they're talking about $1.5 billion in direct payments of up to $2,000 to each borrower who lost their homes to foreclosure. So you have to wonder, what is the damage suffered? What are they compensating these people for? They've lost their homes, which, by the way, probably was a good thing because they bought their homes at a very high inflated price. It was probably the best thing for them that they could walk away, jingle mail their keys back, be done with it, and go and either buy another house in a little bit or rent until the prices stabilize at a more reasonable rate. Nevertheless, these were the people who, if this was a punishment for robo-signing and some of the documentation fraud, these people obviously were half of that fraud because they signed for a house they couldn't pay for. Now, you have to remember, in this whole thing, these were homes that went into foreclosure, okay? And these were homes that were many of them were homes on fixed rates. Some were variable rates, and if you remember, it was the maestro, Alan Greenspan himself, of the Fed, who actively encouraged homeowners for a couple of years to take variable rates on his promise that rates could only fall, which they have, but the rates that these people signed for somehow exploded. So that was a bad decision in the first place. But assuming that these people didn't make the bad decision to go with a variable rate, they actually went with a 30-year locked interest rate. The question one would have to ask is, why did their home go into foreclosure? Because their payment is fixed, right? So when they signed the loan, they knew they had to pay $1,500 a month. 5 years later, they still had to pay $15 a month. So why couldn't they pay $1,500 a month? And the answer, of course, is because of this: unemployment. In other words, it wasn't the fact that these people paid too high of a price for their house. As long as they were employed and they could afford that payment, which I'm assuming they could because they were able to make it for quite a while before they defaulted, then the actual reason why they defaulted was their job situation, their income situation. It had nothing to do with the price of the house. So that's a deception right in and of itself. But back to the main story. This story, when you look at what they're proposing, this tells you that they have not learned their lesson. And the only lesson that they've learned out of any of this is that the cure for hangover or the cure for debt is more debt. The cure for alcoholism is more alcohol. They haven't learned their lesson. Of course, the lesson that should be learned, which is what Peter Schiff is always talking about, is we need to let the housing market clear. They need to let housing prices fall to whatever they're going to fall to where people can afford them. Yes, there will be more houses that go back to the bank. There'll probably be people like me that might end up being underwater by an enormous number who'll just keep paying because that's their contractual obligation and they feel obligated to pay that. There'll be others that will walk away, but at least the housing market would clear if they would simply let prices fall to a market rate. And of course, if they did that, if you had houses that were fairly decent houses that fell to say $40,000 or $50,000, you could actually have the working poor and others be able to afford those houses, and the market would begin to resume its rise. But of course, we have the people in power right now who are of the kick the can down the road school, and more debt on top of old debt is a good thing. So we're emulating the Japanese experience of who have experienced going on 2.5 lost decades in their economy because they will not repudiate this bankrupt doctrine of central planning, and that seems to be the course that we're following. So as far as the fundamental picture of the money situation, nothing has changed. They continue to print money. The situation gets worse and worse and worse. And of course, the supply and demand side for silver just gets better and better and better for the longs. So we're looking for a potential rollover here. A correction down to 30 or even lower would be nice. It would be nice if the doom and gloomers were right and we actually got finally a correction back to that 22 level and then took off. I seriously doubt if you would be able to stack very much silver at all if we went back down to 22. My guess is most of the places would just close up shop and there just wouldn't be any available at all. But we're looking for a dip. Hopefully you can stack some more if we get that. If not, we need to rise fairly rapidly from here and just continue this uptrend. And we'll talk to you next time.